Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
Welcome to Quora, where we dive into the world of finance and explore the latest market trends. Today, we're talking about the S&P 500's 3-week winning streak coming to an end, and what this means for U.S. equities. The S&P 500 is still recovering from a notable gain of 0.59% on Friday, which snapped its 3-week winning streak. This development reflects the market's ongoing tug-of-war between optimism about consumer strength and economic growth, and concerns that inflation hasn't moderated quickly enough for the Federal Reserve to ease policy comfortably. Let's take a closer look at what's driving this uncertainty. Personal spending data continues to show that final demand remains resilient, thanks in part to the purchasing power of middle and high-income groups. This has helped keep the current quarter's GDP outlook solid, with 3.8% growth versus expectations and 3.3% in the prior month. However, core inflation in services, particularly housing, healthcare, and insurance, remains sticky. That's why the Fed is maintaining a cautious stance. It doesn't want to tighten policy excessively and damage the labor market, but it also can't move aggressively toward rate cuts while inflation has yet to return to its 2% target. Now, let's talk about the impact of U.S. Treasury yields on equity valuations. When yields rise, the equity risk premium narrows, reducing the relative attractiveness of equities and putting long-duration growth stocks like technology and communication services under pressure. On the other hand, when yields ease, large-cap tech, especially companies tied to artificial intelligence, tend to rebound quickly and drive the index higher. At Quora, we're keeping a close eye on corporate performance, which continues to enjoy momentum thanks to the investment cycle in AI infrastructure. Revenues and earnings in the tech sector are supported by surging demand for data centers and processors. However, the market has begun to demand greater clarity on free cash flow generation in the coming quarters to justify elevated valuations. Meanwhile, interest rate-sensitive sectors like commercial real estate and durable goods remain under pressure, while defensive areas like healthcare and consumer staples continue to show stability. It's worth noting that the heavy concentration of performance in a handful of leading stocks raises risks. If large technology names falter, the broader index could come under significant strain. Now, let's talk about what this means for the near-term outlook for the S&P 500. The market is likely to remain constructive but not overly strong, as inflation is easing only gradually and the Fed keeps rates higher for longer. This suggests the index will continue to trade positively, but with intermittent pullbacks. However, a more optimistic scenario would unfold if service inflation declines faster, enabling the Fed to signal a clearer path toward policy easing. Conversely, a negative scenario could emerge if yields spike higher or labor data deteriorate unexpectedly, pressuring valuations and earnings prospects. This week, market attention will turn to a series of key economic releases: JOLTS job openings, ISM manufacturing PMI, unemployment claims, non-farm payrolls, and the unemployment rate. These indicators provide direct insight into the health of the U.S. labor market and the broader economy, and they're crucial benchmarks for the Fed in assessing the progress of disinflation. Should the data reveal continued moderation in labor demand and wage pressures, expectations for the Fed moving closer to a rate-cutting cycle will be reinforced, supporting risk sentiment and the S&P 500's rebound. On the other hand, any signs that the labor market remains too tight or that service inflation is not cooling fast enough will heighten concerns that the Fed may need to keep rates higher for longer, thereby limiting the near-term upside for U.S. equities. That's all for today, folks. Thanks for tuning into Quora. If you want to stay ahead of the market and make informed investment decisions, be sure to subscribe and hit the notification bell. We'll see you next time.